Over the last few weeks, federal employees across the country have been subject to many different offers in an effort by the administration to reduce the number of federal employees. We want to ensure that you have a clear understanding of your amazing benefits and how they might be impacted. Federal Employee Health Benefits, or FEHB, are an important part of your life. In this episode, we share our insights on how force reduction programs relax eligibility rules, discuss how MRA plus 10 and MRA plus 20 are eligible for FEHB, offer a few considerations if you realize you will not have FEHB when you leave federal service. Hello, my name is Zubin Kapoor, and I'm a financial planner at Valor Wealth Partners. Financial Planning for Feds is dedicated to educating federal employees on how to maximize value from their complex yet underutilized federal benefits. Now, before we get started, a few quick reminders. If you're fully eligible on the last day of your service, you will qualify for FEHB. Please keep in mind that the government subsidizes the cost of health benefits while you're working and in retirement. In retirement, the amount you pay is after taxes, as compared to while you were working, you were paying before taxes. Roughly, an employee pays about 28% of the cost, and the government subsidizes the rest. Now, there are two programs that are being offered that are key to know about. The first one is VERA, or Voluntary Early Retirement Authority, and is also known as an early out. The other one is the DSR, which is discontinued service requirement, is when a position is no longer deemed necessary. Now, DSR is involuntary, whereas the VERA is voluntary. It is important to know that the eligibility benefits in both these situations are relaxed. The eligibility is lowered to 50 years and at least 20 years of service, or any age and at least 25 years of service. Now, these programs will enable you to be eligible for FEHB earlier than under normal circumstances. So these two are very important to keep in mind. Now, what happens to those federal employees where the relaxed eligibility requirements of the VERA and the DSR do not apply? Now, here there are two scenarios under the minimum requirement age rule, MRA plus 10 and MRA plus 20. Now, let's assume under the MRA plus 10 scenario, you are 58 years of age and have 12 years of service. You don't qualify for the relaxed eligibility rules because you don't have 20 years of service, even though you're more than 50 years of age. So in this case, you have two options under the MRA plus 10. You can put in for an MRA plus 10 retirement, and in this situation, you are subject to a penalty on your pension because you're retiring before you're fully eligible. But the advantage is that you will get FEHB right away. Or the other option is to put in for a postponed retirement, and in this case, your pension will start at 62 years of age, but without any penalty. But this gap between 58 and 62 years of age, you're not eligible for FEHB and therefore have to look for other sources of getting medical coverage. Now, in the MRA plus 20 scenario is very similar to the MRA plus 10, the only difference being that you can start your pension at 60 without any penalty instead of 62. If it so happens that you're not eligible even under the MRA plus 10 and MRA plus 20 scenario, then what happens next? Of course, if you're lucky enough to be a dual fed couple, then you could get FEHB through your spouse if your spouse has had at least 5 years of coverage, even if it was under your FEHB plan. Or if you have a spouse that works for another company that offers medical coverage, you could switch to that plan based on what is called a life qualifying event, or an LQE. The LQE in this case is a loss of your health benefits due to losing your employment with the federal government. Now, if you're above 65 years of age, you could also consider Medicare. By now, you have determined that you are at risk for losing your health benefits. You have 31 days from your last day of service to decide whether you want to keep your current health insurance provider. Now, this could be whether you have GEHA or United Healthcare or Blue Cross Blue Shield. It doesn't matter. By law, you are required to have the option of keeping your medical coverage. Now, you have the option of keeping the same coverage for a period of 18 months. The issue that you have to be concerned with is that you have to pay for the entire amount of coverage, including what the government subsidized for you. And actually, you have to pay 2% more. So you will end up paying 102% of the total cost of coverage because the additional 2% is for administrative costs. Now, how do you get to figure out what that average cost of a monthly health plan might be? So if you take what you're paying on a bi-monthly basis or what you're paying on a per period and you multiply it by 3.5, you'll get a very rough sense of what the total cost of that coverage might be. So for example, let's take a Blue Cross Blue Shield standard plan for Self+1. You're probably paying about $384 per pay period. And the plan in total costs about $1,350 per pay period or $2,900 per month. Now, a Blue Cross Blue Shield basic plan for Self+1 would probably be a little bit cheaper at $274 per pay period. And if you use the 3.5 average rule, you're paying probably $2,100 per month. Now, these can get really, really expensive. So before you make a final decision, please ensure you check out the ACA or the Affordable Care Act. The government offers medical coverage from a variety of health insurers. The government will also subsidize your coverage based on your estimated income for the year and the number of people of your family that are covered. This is via the ACA or the Affordable Care Act, also called in some places the healthcare marketplace. Now, this subsidy that you are provided is automatically deducted from your monthly total, so you're paying less than what the true cost of the plan might be. Now, at the end of the year, when you file your taxes, they will look at what your estimated income was and what subsidy was given to you on a monthly basis, and those two items will be reconciled. So for example, if you had greater income than you had estimated, then your subsidy would be reduced. Now, I would suggest that you find a ACA health broker to guide you through the process. Find one that you can trust. Now, brokers are compensated by the insurers, and it should be of no cost to you. I have used one in the past, and it was easier to work with them than to try navigate the marketplace on your own. The one thing you need to keep in mind with the Affordable Care Act is that your choices may not be as robust as you had with the FEHB, and they probably have higher deductibles. So please carefully consider the options. These are trying times, and there are many decisions to be made. Please ensure that you are clear on the eligibility rules of the different types of offers that are being made. In addition, if you have some time before your last day, please ensure that you and your family are taking advantage and seeing the doctor before your benefits expire. If you are unable to get a subsidized health benefit through your spouse, you have the option of staying with the same coverage, albeit at a much higher cost. You should also explore the options offered by the ACA or the health marketplace. Please keep in mind, the ACA could offer you a subsidized plan. Before we sign off, researching your options will help you make informed decisions. We want the best solutions for you and your family. Please get unbiased, conflict-free advice. Until next time.